Good evening, and welcome back to Mo's channel. Today is February the 18th, 2019. Today I want to talk about investing. Now, I've spoken about starting a business, real estate development, and now I want to talk about investing. When I speak of investing, I'm going to speak specifically about stocks. There are a variety of securities out there that are traded on exchanges. You have Chicago Mercantile Exchange, Chicago Board of Trade. On those exchanges, futures contracts are traded. What is a futures contract? Coffee. Everyone drinks coffee, tea, rubber, cattle, livestock, hogs, timber, weather, gold, silver, oil, crude oil, natural gas. These are all commodities. Now, when the concept of futures markets came about, it was to provide some sort of security for the producers of commodities such as farmers, miners, to ensure against potential adverse market fluctuations. So, if I'm a farmer and I grow wheat and I spend $100 to grow 1 bushel of wheat, I'd like to sell that bushel of wheat for about $120 to realize a $20 profit per bushel. In the futures world, I could buy or I could sell a futures contract that would ensure that in the future, should that bushel of wheat fall to $80 a bushel, since I sold that futures contract for $120, that means I've locked in that price of $120. So when I deliver that futures, when I actually harvest my wheat and I'm ready to sell it, I have a buyer who will pay me $120 a bushel. The same goes for crude, gold, silver, whether that's really for farmers to secure themselves against adverse weather developments. That was a primary purpose for which futures markets were established. Now you have speculators, people like me, who might come in there and look at gold and say, well, I anticipate that within the next week, the next month, the price of gold should go up from its current $800 an ounce to about $900 an ounce. So I buy a contract of gold futures. When the price goes up, I sell it and make a profit. Now, you also had, you could play this on treasury bonds, 30-year, 10-year, 5-year, 2-year, even 3-month treasury notes. So that's a futures market. You'll take another step back and come to the options market. Now, the options market is concerned with buying or selling an option on an underlying security. And these securities could be stock equities or futures contracts. So, for example, if I look at Apple and I see Apple is currently trading at $100 a share, but I know that Apple is about to release a new iPhone 50. And I anticipate with all the new features this iPhone 50 will have, it will garner significant market share in the smartphone space for Apple. But I'm not sure. So what I could do, I could buy a call contract, a call option contract. What a call gives me the right, it gives me the right to call, to buy that security, that underlying security for the strike price. So I could buy a call contract on Apple with a strike price of $105 with anticipation that once Apple releases its iPhone 50, the stock price will go up to $150. What does that do for me? If Apple does release that iPhone 50 and the stock price goes up to 150, I can now exercise my call option contract and either buy Apple for $110 and turn around and sell it for $150, or buy it for $110 and hold it. So those are options, those are futures. My discussion today will not focus on options or futures. My discussion today will focus on stocks. So let's talk about stocks. You have publicly traded stocks. So let's establish this from the onset. Any company can issue stock. All that stock is a stake in the ownership of that company. You could start a company. You blow it up to $1 million in revenue. You want to go to the next level. So what do? You issue stock to friends, family, people that you know, and you issue that stock at $1,000 a share. You want to raise $1 million. So by issuing it at $1,000 a share, if you could sell 1,000 shares, then you've now got that $1 million. Now, I, as a buyer of the stock in your company, I now have ownership rights in your company, which means I can now influence the management decisions. I make that influence at the board level. So you have the board of directors. The board represents the shareholders because the shareholders elect the board. So by owning stock in your company, I now have a right to elect the board of directors. That board of directors will establish the strategy for the corporation, and they will appoint a CEO, a CFO, and so forth. And they will hand that strategy to the CEO. The CEO reports to the board. The CEO's responsibility is to maximize shareholder value. So let's clarify that. A corporation exists for the sole purpose of benefiting the shareholders, because the shareholders are the owners of that corporation. A corporation does not exist to provide employment. A corporation does not exist to provide social services. You, as an employee of that corporation, are an expense item. On the balance sheet, employees are recognized on the income statement as wages expense or salaries expense. Employees are not assets. Assets are recognized on the balance sheet under assets as opposed to liabilities. You have current assets, you have fixed assets. When a company invests in assets, it increases the value of those assets, and that is reflected on the balance sheet. Therefore, technically speaking, from a legal and financial perspective, corporations have no obligation to their employees or to the government or country or city or state in which they operate. Corporations' only responsibility is to the shareholders of that corporation. Now, let's talk about the process through which a company becomes public. You start a company, you manufacture Bluetooth speakers. You grow your company. You reach a certain point where you want to expand your market share. But that requires you to invest in plant and equipment, as well as to invest in marketing and possibly to acquire some retail outlets to sell your speakers. Let's say you need $10 million. You go to a venture capitalist. What is a venture capitalist? A venture capitalist, they're usually structured as partnerships, but these are entities that provide funding to startup companies to enable those companies to grow and expand. You usually have several rounds of funding. At the initial stage, you might seek out an angel investor. They might fund you with $50,000, $100,000 to get you off the ground. Subsequently, you might seek out a first round funding, then a second round, and a third round. The first round funding might infuse you with $1 million. The second round funding might infuse you with $10 million. The third round funding might infuse you with $50 million. Now, for each of these funders, you give up a portion of ownership of your corporation, because these venture capitalists are funding your company with the intent of taking it public, such that when they take it public, the $1 million that I fund into your company and get a 20-30% stake in your company, when I take it public, I hope that $1 million turns into $10 million or $100 million. That's how VCs make their money. Now you've gone through the first stage, the first round funding, second round, third round funding. You've grown your market share. You're now pulling in $100 million in revenue. 8 years later, you now go to an investment bank. What do investment banks do? For the purposes of corporate equities of stocks, investment bankers will perform due diligence on your company, and then they will buy stock from your company, the primary offering. They will then sell that stock to the public market. So they act as an intermediary between your company and the public market. In most cases, you'll have a lead underwriter. The lead underwriter will perform all the due diligence. Now, due diligence is looking at your company to determine, are your financials sound? If you say you make $100 million in revenue off of $40 million in expenses, is that accurate? If you say you expect to reach 30% of market share within 6 years, is that accurate? That's what they will look at. They will also perform valuation. When I say valuation, you have book value. The book value of a company is its assets minus its liabilities. That is the book value of the company. You also have current earnings and potential earnings. Now, potential earnings are established based on looking at the market what percentage of market share you have, what the potential of the entire market is in terms of revenue generation, and what the probability is of you capturing a certain percentage of that market share within X period of years. Based on that, they do what is called discounted cash flows, which is based on net present value analysis to roll it back based on those future earning streams. What should we value today's earnings potential at? Stocks are priced based on the price earnings multiple. The price earnings multiple is generally standard within an industry. An example might be the chemical manufacturing industry might have a price earnings multiple of 15. The software development industry might have a price earnings multiple of 30. The cloud services industry might have a price earnings multiple of 25. The healthcare providers industry might have a pricing earnings multiple of 10. So if you're a healthcare company and you intend to go public, and based on discounted cash flows from projected 5-10-year earnings, it is established that your potential earnings are $10 million. If your industry, your healthcare industry, has a price earnings multiple of 10, then the total market valuation, and total market valuation is simply the number of outstanding shares times the stock price. So if your potential earnings discounted today is 10 million, the price earnings multiple is 10, then your total market value should be $100 million today. Now, if you intend to issue 1 million shares in your IPO, that means that the investment bank, the lead underwriter, will price each stock of share at $100. So, that is the target price they expect to get from the market, $100. They will pay you, your company, $80 a share times 1 million shares. That is $80 million you get from that IPO. Now, the lead underwriter will form a selling syndicate. That selling syndicate are other investment banks that the lead underwriter will bring in and will distribute these million shares to these other investment banks to go out and sell on the market. So I buy from you $80 a share, 1 million shares. I put $80 million in your pocket. I would then sell it to these syndicate members for $90 a share. So I make $10 million. I buy it for 80, sell it for 90. I make $10 a share times 1 million, $10 million. Each of these syndicate members will then offer that at $100 a share. So they'll make $10 a share. If I have 5 syndicate members, I'll give them each 200,000 shares. So they'll make $2 million off of that offering. There are a lot more details that go into the underwriting process, tombstones and things like that, private placements. Perform your own research. That information is out there. Dig in, find out. So now let's talk about, before we go there, let me clarify one thing. I am company XYZ. I go public at $100 a share. From the lead underwriter, I get $80 a share. I get $80 million. The stock goes public at $100 a share. That's $100 million. If that stock goes up to $500 a share, I, XYZ company that issued that stock, do not benefit. The people that benefit are the shareholders. So if you as a shareholder bought it for $100 a share, it goes up to $500 a share, you make $400 profit. I don't make any profit. However, the insiders of XYZ, that's the CEO, the CFO, the CIO, other executives who might have gotten stock options or shares of stock as part of their compensation package, they might get that stock at $5 a share. If the stock price goes up to $500, they make $495. That is one of the primary drivers for jobs, American jobs, going to China, going to the Philippines, going to Vietnam, going to India. Because if I am the CEO and I send jobs out of the country and I reduce the cost of operations, I increase earnings. If I increase earnings based on the price earnings multiple, the stock price goes up. If the stock price goes up and I hold options or stocks in that company, I could cash out and make myself a multi-millionaire. So all these jobs going to China, all these American jobs that were leaving America, going to other countries, serve nothing but the executives of these corporations. The second thing I would like to outline, I'm a trader, and I've been involved in the spot FX market, which is foreign currencies, about $1 trillion, $2 trillion worth of currencies traded each and every day. I've been involved in the futures market, the stock market, options market. So a lot of what drives the stock market has nothing to do with economic reality. Nothing whatsoever. Two things drive the stock market: fear and greed. Let me explain. When a stock starts going up, what happens is a lot of people start to jump on the bandwagon. Apple's going up. Let me make some money. When the stock starts going down, a lot of people jump off the bandwagon. Apple's going down. I don't want to get burnt. Let me get the fuck out. However, Apple might be going up or Apple might be going down because of nothing whatsoever to do with Apple. Microsoft might have reported poor sales. Microsoft is a technology company. So the herd mentality says a technology company reported poor sales. That means all technology companies are going down. No logic whatsoever. It is simply a reaction. As a result of that, if I own Oracle, Cisco, Apple, Nokia, I start selling. Nokia might be strong as hell, but simply because Microsoft reported poor quarterly earnings, fear takes over and they start selling. A lot of what was driving the stock market up in the past, number one, coming from 2008, the Federal Reserve bought a lot of toxic assets. These were basically collateralized mortgage obligations, CMOs. These are financially engineered instruments whereby a bank lends you money for a mortgage. It turns around and sells that mortgage to an investment banker. An investment banker will then take that mortgage and package it into a CMO. CMOs typically have two tranches, one that pays on the principal, one that pays on the interest. So when you pay your mortgage payment, that's a payout on the interest portion. When you pay principal on your mortgage, that's a payout on the principal portion. Now, I could go into detail about how these CMOs are not properly scrutinized, where you had subprime mortgages being bundled with prime grade mortgages. So once the subprime mortgage failed, the whole package failed, even though the prime grade mortgage was performing. It is a lot of fraud, a lot of illegality, and the fact that a lot of these CEOs of these companies were not jailed speaks volume to the influence of money in the political system. That was bad enough. The banks. So if I'm a bank and I lend you money, that is a liability on my books. It's not an asset, it's a liability. If I have 10,000 in deposits and I have a multiplier of 10, that means I could lend out $100,000. If I lend you $50,000, unless I take in more deposits, I can't lend out more money. I can only lend out an additional $50,000. By selling this mortgage to an investment banker, I take it off my books. So now I have an additional $50,000 to lend out again. So that's what banks were doing. They were getting rid of the paper so they could get more money to lend out. That's not bad. Where it became bad is when these same banks, due to the repeal of Glass-Steagall, these same banks went out there and bought these CMOs. So I sell a mortgage to an investment bank. The investment bank creates a CMO. I then buy that CMO. When these CMOs started defaulting, the banks were losing capital. At this time, the banks had all of their surplus capital out there trading. Banks were trading. They were trading with your money. They were speculating with your money. Because of that surplus capital that's out there in the markets trading, and it's tied up in positions, when the CMOs started to fail, the banks had liquidity issues. That is why the market collapsed in 2008. Congress, the White House, being as stupid as they are, did not realize that there's only one simple fix to ensure this does not happen again. Separate commercial banking from investment banking. If you are a commercial bank, you cannot participate in investment banking activities. You cannot own exotic derivatives. You cannot own stock of other companies. You cannot own futures. You cannot own spot FX, and you cannot trade. You are in the commercial banking business. What that does is if you have another failure, it does not affect commercial banking, because commercial banking is who lends out to businesses and to consumers. Investment banks can fail. That's okay. They could fail. It will not impact the economy. Commercial banks failing will bring the financial system to a standstill. So the Fed had on its books, and it still has about 5 trillion of toxic assets on its books. On top of that, the Fed lowered the Fed funds rate to zero. What does that mean? Banks borrow from the Fed through the Fed window, and they pay the Fed funds rate. So if a bank goes to the Fed and borrows $1,000,000 and the Fed funds rate is 5%, they will pay the Fed back $1,000,000 plus 5%, which would be 50,000. If the Fed funds rate is zero, then the banks are basically getting free money. The idea behind setting the Fed funds rate to zero was such that banks would get free money from the Fed and turn around, pump that money into the economy. What the banks did, they got free money from the Fed and put that money on the markets, speculated with that money. So banks failed in their function. It would have been much better for the Fed to set up a government funded, a government controlled clearinghouse and pump that money into that government clearinghouse and then allow small businesses to come to that government clearinghouse and borrow money, as opposed to giving that money to the banks, which did not do what their function was. The second thing that drove the stock market so high, when Trump gave corporations this tax holiday. The thought was the corporations would take that increased money, turn it into additional employment opportunities, and expand their production capabilities. What did these corporations do? They went and bought back their stock. By buying back their stock, they reduced supply. By reducing supply, they increased the price of the shares. For the most part, this only benefits the executives. It does not benefit the little man on the ground. So the reason I say this is because you have to understand there is zero correlation between the performance of the stock market and the economy. The economy is based on book value of companies, not on market value. The only people who benefit from a rising stock market are those people who are invested in the stock market. Corporations, employees, consumers. If you're not invested in the stock market, a rising or falling stock market has no impact on you. So this nonsense of jubilation when the Dow Jones is going up or the S&P is going up or the NASDAQ is going up, the economy is doing good. No, that has nothing to do with the economy. This fear and doom, the market dropped 1,000 points today, or it dropped 700 points today, or it dropped 800 points today. The economy is going to ruins. No. Stop being fooled. The stock market has nothing, zero to do with the economy. Let's move on. How do you invest in stocks? First, let's understand you have traders, people like me, otherwise known as speculators. I typically, if I'm playing a stock option, I will be in and out of a position within a day. I will not hold a position overnight. If I'm playing an option on a futures contract, such as the S&P 500 or gold or silver, or 30-year bonds, 10-year bonds, whatever you have, the euro, the pound. For futures, I will typically be in and out of position within 1 hour. I'm not looking for big gains. If I'm dealing with futures and I go in and I open the option position for $600, and I know within the course of a 6-hour period, I could play at least 10 transactions, 10 positions, all I need is 10% from each position. So if it's $600, if I get $60 profit, $60, 10 times during a day, I've made $600. I've doubled my money. I've gone from $600 to $1,200 in a day. If I'm playing stock options, all I need is 30%. I go in with $600, I make 30%, 40%, I get $240 profit. I start $600 today, Monday. By the end of Monday, I've got $840. Do that day in, day out, day in, day out. At the end of the week, I've taken that $600 to at least $3,000. That is a trader. There's more risk involved, but there's potential for higher profitability. With my system, there's no risk involved. I cannot lose money. I can only make money. An investor has a longer term horizon. Typically, an investor will hold a stock for at least 6 months. More likely for a year or even 5 years. Situations have changed. Once upon a time, companies, and this is before the 80s, companies were managed for the long term. You'd have corporations would develop 10-year strategic plans, 5-year strategic plans, and then 3, 2, 1-year tactical plans. So those tactical plans would derive the annual operating budgets. The strategic plans would govern the long-term funding requirements. Corporations used to pay out dividends. Now, at that time in history, you might buy 1,000 shares of GE. You might buy it today for $50 a share. Pay $50,000 with anticipation that over the course of the next 10 years, GE might pay out $1 in dividends each year or each quarter per share. You got 10,000 shares, so each quarter you get $10,000. At the same time, due to proper management, long-term strategic planning, after 10 years, GE stock would go from $50 to $60. So you get $4,000 a year in dividend income. For 10 years, that's $40,000. And then the stock price goes up to $60, so you make $10,000. So that's an additional $10,000 off of the 40, so you make $50,000. Profit. So in 10 years, you make 100% profit. If you're compounding that 10-year profit might actually go from 50,000 to about 100,000. So if you're planning for retirement, you could buy stock in different companies with anticipation that management having a fiduciary responsibility to the shareholders would manage that company for long-term growth. That's no longer the case. That is no longer the case. Management now has its only purpose to maximize the stock price in the short term. Doing so ensures that the stock price goes up and they could cash out on their options at the end of each quarter, and you have a CEO that's in position for 5 years walks away with $300 million. And the shareholders, they lose money. Who gives a fuck? I got my money, fuck you. However, you can still invest in stock. And these would be my recommendations to invest in stock. Number one, do not listen to the financial analysts. Do not listen to the financial analysts. Do not listen to your stockbroker. As a stockbroker, whether you make money or lose money, I'm going to make money because I'll charge you commission on each transaction. Every time you buy stock, I'm going to charge you commission. Every time you sell stock, I'm going to charge you commission. So if you lose money, it don't matter to me. I make my commissions. Fuck you. All right? The financial analysts, a lot of them are given favorable treatment for recommending certain stocks. You might have Bank of America. They come out and recommend, they put a buyout on Best Buy. But Bank of America might have $50 million invested in Best Buy. Bank of America might have lent Best Buy $10 million. So it is in their interest that Best Buy continues to succeed so they can get their money back. So do your own research. When I say research, look at a company. Look at their financial statements. Understand what their financial position is. Look at their balance sheet. If a company has $50 million in assets and $30 million in liabilities, that is a company that could very easily find itself in financial trouble because it cannot pay off its liabilities. Stay away from them. Look at the cash flow statement. Look at the income statement. You want to make sure that a company, this is the income statement, you want to make sure that a company is making profit off of its assets. If I make computers, I should make profit off of the sales of computers and not of some insurance policy that I have or some stock investments that I have, because that is not my primary business. Look at the income statement and make sure that that company makes the majority of its profits from its primary business function. Look at the cash flow statement. If a company has 50,000 in receivables and 60,000 in payables, that is a company that's operating in the red. Stay away from them. You want to be with a company that has a cushion of cash. So if they have 50,000 in payables, they at least have 70,000 in receivables. Then look at the receivables aging. If most of their receivables are over 60 days, they're not likely to collect that full amount. So you want a company where most of the receivables are less than 30 days old. That lets you know that that company is constantly bringing money in so it could service its debts and expenses. So do your own due diligence. When you buy the stock, look for undervalued stocks. The way you locate undervalued stocks, look at the price earnings multiple. If it's a company that's in the software development world, such as Microsoft or Oracle, and the price earnings multiple for that industry is 15, and this company generated $1 billion in revenue, then it should have a market capitalization of $15 billion. If it has a market capitalization of $12 billion and all else looks good, then that means that company is undervalued by about $3 billion. That is a good buy. That is a stock you should look into. Just buying the stock does not end the story. You want to buy the stock, but you want to protect yourself against potential losses. There are two ways you could do that. You could buy the underlying and sell calls or write calls on that underlying. So if I buy 1,000 shares of Apple for $100 a share, that means I spend $100,000. Now, if I sell calls on Apple with a strike price of $105, I might get $5 a call in premium. That $5 a call now gives me that comfort zone that I can now